Hello and welcome to Rajya Sabha Television. You're watching a brand new edition of Policy Watch with me, Frank Pereira. With effect from November 1st, 2017, the lending rates offered by State Bank of India across maturities has changed. In a notification issued on Tuesday, the country's largest lender by assets reduced the rates by 5 basis points or 0.05%. This is the first reduction in the bank's marginal cost of lending rate in 10 months and follows a decline in the cost of funds after the bank cut interest rates on savings deposits from July 2017. Flush with deposits after a surprise scrapping of high-value notes last year, banks led by SBI had last sharply cut lending rates under the MCLR system in early January. On this edition of Policy Watch, we will analyze what the rate cut means for the common man and is there scope for a further cut. Joining me on the program today are Nitin, Desai, former Chief Economic Advisor, Government of India, and Sandeep, Bamzai, Editor-in-Chief of the Financial Chronicle. Thank you to both my guests for joining me on this edition of Policy Watch. Mr. Desai, I'd like to begin with you, of course. What does this rate cut mean for the common man?
Well, particularly since it's across all maturities, it would mean 0.5% is a reasonably significant cut, and it will certainly make a difference to, say, a household's EMIs, or it will probably also help a lot of smaller industries and so on. There are a couple of things which I would like to stress. One, we have had a problem of the transmission of the cuts in the policy rate to the banks. We've had this problem. Second, we've been really fiddling around with the system, the determination of these lending rates. We first had the bank prem lending rate, then we switched to the base rate, and now we switched to this one, the marginal cost of lending rate. And I hear that they are now looking into changing this also. So there is the idea was to have a certain transparency in this process. The third thing is, part of the reason why the repo rate thing does not immediately translate is because what the bank is concerned with is its cost of funds. And to a certain extent, there is a restriction there because there's a limit to the extent to which they can reduce deposit rates, because they're competing with small savings. So there's a point beyond which you can't really go too far in that direction. Also, they don't borrow that much. I mean, if you took the total assets of banks, about 10% is on average is the borrowing from the liquidity facility. Now that is not big enough to determine the cost. So the impact has to come basically through the sorts of a market leader like SBI putting the rate down. So I think the real impact of this will be this will force a lot of other banks to do the same. And therefore, there will be a much broader cut. And I think 0.5% is not bad. Incidentally, the repo rate has come down by about 2%.
Yes.
So in the past 2-3 years, 200 basis points.
Yes.
Here between the January 1 and now, we're still nowhere near the 200.
Yeah, I mean, that's a very valid point that Mr. Desai has just raised, Sandeep Bamzai. The RBI rate cut, the banks have not extended it to its customers. What's the reason, really? I mean, what's it that they're concerned about?
One clarification, it's not a 50 bips cut.
It's a 5
bips cut.
Yes.
So 5 bips is nothing.
0.05%.
0.05%.
Yes, 0.05%.
It's not 50. No.
Oh, I thought it was 50 basis.
No,
it's just
0.05 is nothing.
So 5 bips is nothing. And what State Bank of India has done this morning is that it's cut its home loan rates and its auto loan rates by 5 bips, and it's made it 8.30 and 8.70, which is a good thing. But as I said at the outset, 5 bips is nothing. Now, given that the benchmark interest rate is at 6%, and this is what, a 7-year low, over the last 3 years, we've actually seen 5 interest rate cuts. But those 5 interest rate cuts, as Mr. Desai also mentioned, have not translated into transmission or a pass-through to the consumers or the people who are availing of these loans.
The MCLR was brought in just for this particular reason, to try and bring about some kind of transparency.
But MCLR is not really working. No,
Why isn't it working?
You have a situation, again, because of the cost of funds. The bank, see, this is, what is MCLR? MCLR is basically the minimum rate at which banks can lend, correct?
Yes.
Now, the cost of funds is such that the banks can't go below a particular rate, which is that rate. And at this precise moment, they're not willing to do so. Despite the fact that the benchmark interest rate is 6%, you still have auto loan, and this is the lowest in 7 years. But yet, you have home loans and auto loans at 8.3 and 8.70. Now, within when you get into the granularity of the State Bank of India cuts this morning, then there is a positive in that if you avail of a home loan of 30 lakhs, you get a rate of 8.30, but you also get an interest rate subsidy of 2.67 lakhs on the Pradhan Mantri Awas Yojana. So it is good to push affordable housing. But is that happening? I don't think so. Because if you look at credit offtake numbers, if you read the eco-raps that State Bank of India is putting out week after week, credit offtake is still extremely poor. It was at a 55-year low till very recently. I don't think it has changed materially over time. And I think for genuine transmission, you need a slightly larger cut. 5 bips is lip service. You need at least a 25 bips cut, and only then, once State Bank of India has done what it has done this morning, you will find the other lenders like HDFC, ICICI Bank, and of course all the other public sector banks who will fall in line. And this is part of the policy of both the government and the Reserve Bank, where they are actually allowing banks to determine the rates, and rather than the Reserve Bank of India gradually lowering the rates. Although they have lowered rates, but it has not necessarily been mirrored by the banks themselves, again because of the factor of cost of funds.
Sure. Mr. Desai, the banks are flush with funds after demonetization, and they've been talking about, the RBI is saying how the banks need to lower their rates so that people can actually start borrowing. We've seen that the demand has not picked up for loans. Do you believe that if the rates are cut considerably by these banks, that the people will actually go out and take loans?
I would say that basically I would like to distinguish between two classes of potential users. One are the small people, and their problems are not just access to credit, but the disruption they have suffered through demonetization and GST, and quite a few units are shut. I think we really have to work hard to restart those units, and there a lower interest rate regime, etc., will help. As far as the larger people are concerned, they're so flush with money. I mean, the big corporations today have nearly 900,000 crores of mutual funds. They're sitting on money, the big corporations. So, so basically their problem is, what do I do with this money which I've parked in mutual funds and so on, because they're not investing. And the problem again is not just an interest rate problem. It's just if they're not investing, they don't see demand growth. Where I hope this can make a difference is in getting retail business going. We mentioned, for instance, housing and vehicles. There's a strong program on affordable housing. So if it can get that going, then I think it can make a significant difference. But then it has to be a little bit more than
5.
0.05. Let's be very clear. 0.05. It has to be something significantly large, because a lot of this stuff is from young people who are working, who are very EMI oriented. They're looking at their household budget in terms of how much of it is going to go to repay this loan. And we are moving into that EMI-oriented type of economy. Therefore, it makes a big difference. So if they do that, and the retail loan business for things like housing and so on picks up, then I think it can make a difference.
Sure. Do you believe that there is elbow room for the banks to actually reduce the rates further? I
would think so. I don't know why this is not actually happening, because see, the culture of mortgage has actually evolved in India. There was a time when you would be heading towards superannuation and you would be thinking of buying a house.
Yes.
Now that has dramatically changed.
Yeah.
Today, dinkies, what are called dinkies, dual income families, they're at the cutting edge of seeking loans both for cars and for homes. And they would prefer not to stay on rent, but they would prefer to take a loan, pay the EMIs and get into a mortgage. So to help that culture going, you need to significantly reduce rates even from this level. And let's understand that these are extremely low rates Because just go back to 2008, 2009, 2007, you actually had home loan rates at 11%.
11%, yeah.
You had automobile loans at 14,
14%,
15%. So from that, this is a considerable change. I mean, we're talking practically of half. Now, from here on, it is, of course, incumbent on banks to do it. And we've seen State Bank of India taking the leap of faith. But 5 bips does not make any sense. And I think it should be a minimum of 25 bips. Only then will you find other banks doing the same. Now, what is the government thinking? The government is thinking, let's push affordable housing. So even the builders have come on board, and affordable housing is the big thing. But is it actually fructifying on the ground? I don't think so. Again, for the same reason that I mentioned at the outset, which is that aspirational middle class is not looking at entry-level cars or entry-level housing. Aspirational middle class in India, which is living in urban agglomerates, and even in tier 2 cities, you'll be surprised, is looking at a bigger car at the entry level and a bigger house at the entry level. So I think there's some disconnect between affordable housing, which the government is pushing, the rates which are being offered, the interest subsidy which is being offered, and who is availing of these loans. Because every day we see newspaper ads saying affordable housing. But if you actually do a dipstick survey, you'll find that very few such projects have actually taken off on the ground. You'll be surprised.
Sure. You know, do you see some kind of pressure going forward from the RBI on some of the public sector banks at least to reduce rates and cut rates in the future?
It's been going on. The governors, at least the past 2 governors, have been making noises, complaining about the fact that it is not being passed down the line. So they will continue. The government will, the RBI will press. In fact, this has partly been the RBI's argument with the government. Saying, why are you telling us to reduce interest rates when these guys, your banks, which you own, are not passing on the rates? You're the owner. Why don't you do something about it? You know? So
this is going to continue, is what you're suggesting. It's going to continue for a while then.
I think it's going to continue, but basically my suspicion is that once the banks, with the recapitalization and so on, once their NPA side stabilizes, then they will be under pressure to deploy their money. And that may help. You see, that the pressure on them to deploy the money, otherwise their books are not going to look that good if they're just going to sit on.
Just to pick up on that, you know, all this while we saw the stock market actually making a distinction between retail bankers and banks saddled with corporate loans, which is essentially bad debt. Now, if you notice in these earnings, the season that we're in, there is a very scary trend which has emerged, which is that the retail bankers have major problems with provisioning. And there is a marked change in what the RBI is saying you have to provision for and what the banks themselves are declaring. So both in ICICI Bank's case, particularly in Axis Bank's case, so there is, you know, all this while we were dealing with a mountain of debt that the PSBs had. Now we have a new phenomenon of private sector lenders who were essentially retail lenders, but who also have terribly bad books. And those books are going to, you know, just as the camels and elephants emerge from under the carpet in public sector banks, the same thing is now going to happen with private sector lenders.
Fine. All right. All right. On that note, then we'll call it a wrap on this segment of Policy Watch. But do stay with us, gentlemen. We'll continue talking about another topic on the other side. It's time for a short break now. Still to come, government looks to expand scope of PSU consolidation. We'll discuss that on the other side. Stay tuned. We'll be right back.
This is Kibutu in Arunachal Pradesh, East Point East on the map of India. Kibutu is dangerously close to the Chinese pressure point. We see first-hand and unseen areas of sand dunes and see how BSF is guarding this difficult territory along the Indo-Pak borderline. We are now slowly entering into the interior-most parts of the Sir Creek area. Indo-Tibetan Border Police Force justifies each word of this thing. Watch super exclusive episodes of National Security Series only on Rajya Sabha television.
Welcome back. You're watching Policy Watch with me, Frank Pereira. For years, public sector companies would just sit on cash without any solid investment plans. That has changed over the last couple of years when they are being prodded to invest or transfer the surplus. And now financial planning is moving to the next stage where consolidation is being recommended for state-run companies across sectors. While the process has already started for oil, construction and consulting companies, power, defense and other sectors could be the next focus areas as the Department of Investment and Public Asset Management goes about making central government-owned firms more financially nimble. In our next segment, we will discuss the scope of PSU consolidation. Still with me on the program now are Nitin Desai, former Chief Economic Advisor to the Government of India, and Sandeep Bamzai, Editor-in-Chief of the Financial Chronicle. Thank you, gentlemen, for staying on and being with me on Policy Watch. Sandeep Bamzai, I'd like to begin with you. Should there be a consolidation of PSUs, do you think?
High time that this was done, and if you spoke about the oil mergers and consolidation in the oil sector. Now this again goes back to UPA. There was a Krishnamurthy committee. Manishankar Iyer as the petroleum minister pushed for this. Unfortunately, it did not take shape. Now I'm very happy to see that this government is pushing for it, and why not? If you can make the public sector apparatus leaner, meaner, more nimble-footed, and if you can give them at the same time scale and size, that is crucial. Now look at I give you the analogy of China. China has 4 or 5 extremely big oil exploration, downstream, upstream, vertically integrated oil majors, Sinopec, CNOOC, etc., etc. Now, with this move, the Government of India is at least attempting to do the same. So, you have ONGC, HPCL, MRPL, you will now have IOC, BPCL, and then so on. Essentially, you will have 3 entities, I think, in the oil sector. In the engineering, consulting space, there's a similar exercise which will be unveiled shortly, where engineers, India, etc., will all be coming together. It makes excellent sense. I remember in the years that I spoke about, Subir Raha as the ONGC chairman, trying to secure oil blocks in Sudan or Angola or Vietnam. And particularly as far as the African experience was concerned, you had a situation where they were just beaten back by the Chinese because they were so nimble-footed. They would promise aid, they would promise arms, while we had to wait for the government cabinet to sit and approve $300 million or $500 million, and only then could you actually make a play for these assets. And the Chinese, Hu Jintao was the Chinese boss at that time, and he himself undertook an African safari and visited all the Mozambique, Angola, Sudan, wherever there was oil and gas assets, wherever they were available, and they were proactive. I hope now with 3 entities, a leaner, meaner approach will be adopted by the government, and I hope the same thing happens in other sectors as well. Sure. Why should you have multiple companies all owned by the government? Of course, there is the Air India example, which is not a very happy experience. But then, if you do it properly, if you structure things properly, if there is a strategic fit, why not?
And this government has shown signs that it could possibly do something like that.
At least it's gone ahead with one, and I think it will go ahead with 2 more.
I was slightly different.
Yes,
because I've seen the way the dynamics of the public sector operates. Basically, what I saw was that the only pressure you have on the top management in the public sector is a comparability with other people's performance. So in the oil sector, each of those heads would be looking at how will I look compared to that fellow, you see, in terms of performance and so on. And in a situation where otherwise we have no incentives or anything, we don't have any management incentives in the public sector, which should get management through. So do not lose the fact that you will have to look at what impact this can have on the management incentives and accountability within the public sector. What I would say is that in areas where there are strategic interests, like you mentioned the oil case, where you are going to be competing with big players globally, it's a good idea for you to become a big player also. Because then you can't just throw your 10 different small fellows in the market. But there are other areas where I think I would take a more elastic view. I also feel this is a more radical idea. I don't think the government will ever do it. But there have been suggestions saying we have been talking about distancing public sectors from political control. You know, we've not succeeded so far because we've left each ministry in charge of its public sector unit. My proposal will be take them all away from ministries, put them into 3 holding companies, put guys in the holding companies, let them compete with each other in terms of delivering results. And you define results. The results may be profits, the results may be investment, results may be external presence, whatever it is, you can define that. Then you'll get something which is a little more effective as a public sector, because you do have a problem of incentives and accountability of the top management in the public sector, and you must do what you're doing.
And a certain sense of complacency comes
this thing will become basically something run by the petroleum minister.
Yeah, but I think one of the good things in this makeover, at least with what the government is attempting in the oil sector, is they're not merging HPCL or MRPL with ONGC. They're actually, ONGC becomes the holding company. HPCL is a standalone refiner retaining its brand and its balance sheet under the holding company.
And focusing on its specialization.
Focusing on its specialization. MRPL again will be allowed, I believe, to do the same thing. Now, I hear that there will be a share swap between HPCL and MRPL. Now, whether these two will actually merge and form one standalone refiner under ONGC or 2 standalone refiners, that remains to be seen. Let's also understand there is a shareholding issue. ONGC owns shareholding both in HPCL and in MRPL. HPCL also, if I remember right, owns shareholding in MRPL. So there is cross-holding also involved in this. And again, it goes back to a legacy system which has been there in this country because of, you know, people trying to dodge the bullet by moving things from the right pocket to the left pocket and doing book entries. So now, finally, if this structure is the construct of this structure has to take place, then you actually need to think it through and make sure that the brand and the balance sheet are separate.
Sure.
Even as they are part of an integrated company.
You know, Mr. Desai, these problems are going to emerge when you talk about some of these big PSUs and consolidation of these big PSUs. Can these challenges be addressed, and can we come up with something concrete and positive?
I think one of the things that does help is disinvestment. Because particularly now that they're talking of even allowing the external holding to go up to 48%, you can't get to that in the big public sector companies without institutional holdings. You can't get it in the normal routine retail. We're not just or through ETFs that they're doing now. So if that happens, then I would expect a certain amount of performance pressures to come from people other than the government, from the institutional investors, etc., particularly if they're foreign investors. Because domestic investors are basically government. You know, because the biggest domestic investor is LIC,
yes,
by far. And so that will just call the government's tune. I think the challenge is to distance it from political interference. Whatever structure you do, ask yourself, is this going to make them more independent, but at the same time address the problem of the accountability and incentives for the top management to in the public sector.
Sure.
So if you address both these issues, so be elastic. Don't, I suspect
one size fits all won't work.
Yeah, like for instance in engineering is a more complicated case. No, because there the real challenge in engineering to me is it's an industry which requires continuous upgradation of skills and technology. The failure of the public sector was that units which are considered wonderful when 20, 30 years ago are just gone completely, HMT.
Sure.
There was a time when HMT was considered a leader.
Yes.
But it did not keep up. It did not have any inherent capacity for moving ahead all the time. So I'd say that my feeling is that ask yourself, how do I generate these pressures? Most important is expose them to competition as much as you can, because only that. Because fortunately, in the rest of the engineering sector, the private engineering sector, we are getting this. We have good companies now in the private engineering sector which are capable of continuous innovation. And defense side, that can be a very big area for improvement. Now they're talking in terms of private sector defense, but we also have a lot of public sector defense capacity. And I'd start looking at that a little more carefully as to what am I doing with that? How can I use those skills better?
Sure. Going forward, then we've seen consolidation in the oil sector. The government has been talking about consolidation as far as PSBs are concerned. What should the next sector that the government concentrate on?
Well, I think this is, if they actually manage to roll out all this, that by itself would be an achievement. You have to undertake a major overhaul of the public sector banking system. You will ultimately, to my mind, have maybe 5 big banks. So of the 27 PSBs, 4 subsidiaries of State Bank of India, Travancore, Mysore, etc. have already been amalgamated. I think that leaves 23 public sector banks. Now, how do you work the math out? Do you attach the weakest banks to the better run banks with better balance sheets? Do you then weaken those banks? Now, this is what you have to work out. And this is what you have to work out very, very quickly. Because if you want to undertake a gigantic exercise of this sort, where you ultimately have 5 big banks, again, the idea is to give them size and scale, and of course, hide the debt on the books of all the weaker banks. This has to be done with great alacrity and with speed of thought, and it needs to be done quickly. I think if you can complete the oil sector consolidation and the public sector banking consolidation before the tenure of this government, I would be extremely satisfied. Okay. And in parallel, if you can go ahead with strategic disinvestment of companies like the one that was announced yesterday for the first time, you had a big company, a good company like Dredging Corporation of India. Actually, the government has taken a call that it will sell 73% that it owns. I would think that by itself would be a satisfying thing.
A quick closing comment from you, Mr. Desai. Is bigger always better?
No, bigger. I think there are areas where consolidation is required. And in my view, in one sense, the public sector bank consolidation is not making them necessarily together bigger, but really there is a serious issue they face. Retail banking is changing. Yes. Changing very rapidly because of digitization, because of new payment system, because of internet. I go to my bank branch once a year. Now, we have these between them, they have an unbelievable spread of branches and so on. Right. Now here, I would actually say bring them together so that they start consolidating, start saving resources. So big is look ahead. Ask yourself, where do I want these fellows to be 10 years from now? All right. A question we've never asked in the past, for the public sector.
All right. On that note, then we'll call it a wrap on this edition of Policy Watch. I'd like to thank my guests, Nitin Desai and Sandeep Bamzai, for joining me on the program and putting things into perspective for us. Before we go, of course, we'd like your feedback on the show. Do write to us at policywatch.feedback@gmail.com and share your views on the program. That's it from us. Thank you for watching. See you again next time.